Hey everyone, welcome back to the Compounding Effect, breaking down investing for smarter wealth building. Tired of the grind? Dream of passive income? Today we dive into dividends, what they are, benefits, calculations, top 2026 picks like AT&T, Walmart, PNNT, JEPQ, and REITs, plus QYLD versus JEPQ showdown. Optimized for beginners and pros. Let's get your money working. Section 1. What exactly are dividends? Hey everyone, welcome to the Compounding Effect. If you're scrolling YouTube right now thinking, how do I get paid without working harder? Stick around because today's video is game-changing. We're breaking down dividends, the secret to passive income that serious investors swear by in 2026. But first, what are dividends, really? Let's make this crystal clear so even total beginners get it instantly. Imagine you and your friends buy a small neighborhood coffee shop. It crushes it. Steady customers, good profits after bills. Instead of dumping every dollar back into new locations right away, you all vote, let's share some profits with the owners. So every few months, each of you gets a check based on your ownership slice. That check, that's basically a dividend. Now zoom out to the stock market. When you buy shares of a company, you're a tiny owner. If it's a mature, profitable business, not a wild startup burning cash to grow, the board can decide to send part of those profits straight to shareholders. Cash right into your brokerage account. Boom. Free money just for holding. Some companies even let you auto-reinvest those dividends, called DRIPs, to buy more shares, turning small investments into big wealth over time. Why are dividends exploding right now? Interest rates stabilized, Fed cuts making bonds less exciting. Inflation still lurking, but dividend raisers beat it. And markets choppy from AI hype. Geopolitics, election vibes. People crave reliable cash they can count on, not just hoping stocks moon. Real cash hits your account, no selling needed. Reinvest and watch compounding magic explode your wealth. Feels good. Real money reduces panic in downturns. Often steadier ride, dividend stocks drop less in crashes. Since 1972, dividends powered approximately 40% of S&P 500 total returns. One beginner trap. Not every hot company pays dividends. Growth beasts like Amazon, Tesla, or AI plays reinvest everything to dominate. Massive price potential, but zero cash until you sell. Dividends, that's the bird in hand. Steady income now versus betting on bigger gains later. There you have it, dividends demystified. You just became way smarter about passive income in 2026. If this clicked, smash that like button right now. It really helps the channel. And stick around because next we're hitting the real power. How dividends build wealth on autopilot with compounding magic. Don't click away. This is where it gets exciting. Section 2. What are the benefits of dividend investing in 2026? Okay, beginners, let's keep this really simple. Why should you care about dividends right now in March 2026? Here are the 5 biggest, easiest to understand reasons. No complicated words, just real benefits that help regular people like you and me. You get paid real money without selling anything. When you own dividend stocks, the company sends you cash every few months just for holding the shares. It's like getting rent checks from a property you own, but you don't have to fix toilets or deal with tenants. Example, put $10,000 into solid dividend stocks averaging 4 to 5% yield. You could get $400 to $500 a year in cash. That's extra money for groceries, bills, fun, or whatever. And you still own the stocks. In 2026, with savings account rates dropping and costs still feeling high, this steady cash feels amazing. Compounding turns small money into big money over time. If you take those dividend payments and buy more shares, your investment grows faster and faster, like a snowball rolling downhill getting bigger. Super simple example, $10,000 invested to 4% dividends reinvested to over 20 years. It can easily double or triple just from the dividends adding up. This is why people call compounding magic. It's one of the easiest ways beginners build serious wealth without needing huge starting money. Dividend stocks usually fall less, When the market gets scary, when the whole stock market drops, like during bad news or recessions, companies that pay steady dividends often don't fall as hard, and they bounce back faster. Why? Strong companies protect their dividend payments. They cut other costs first to keep paying you. That makes investors feel safer holding them. In choppy 2026 markets, many beginners feel way less stressed owning these calmer stocks. Dividends help fight rising prices. A lot of great dividend companies increase their payouts every single year, some for 25, 50 plus years straight. If your dividend grows 4 to 6% a year and inflation is 2 to 3%, your buying power actually goes up over time. Your money keeps working harder than prices rise. Perfect for 2026 when some costs, food, energy, still feel expensive. It feels good and keeps you from panic selling. Seeing actual money land in your account every quarter or month is motivating. It reminds you, I'm getting paid to own this. Why sell now? That little psychological win helps beginners stay invested through ups and downs instead of selling at the worst time. Dividend stocks/funds doing better than the overall market so far this year. They give calm income while tech/AI stocks swing wildly. Perfect mix of cash now plus growth later. See, dividends are not boring. They're smart, steady, and beginner-friendly. You get paid to wait, your money grows faster, the ride is smoother, and you sleep better at night. Section 3. How dividends are calculated. Super simple explanation for beginners. Okay, everyone, dividends sound awesome. But how do we actually figure out how much money we're getting and if it's a safe one? Don't worry. Sornum, we're going to make this super simple. Just 3 main things every beginner needs to know. We'll use real March 2026 numbers. Dividend per share, DPS, the actual money you get per share. This is the dollar amount the company pays you for each share you own. Real example right now, AT&T pays $0.2775 every 3 months quarterly. So over a full year, 0.2775 times 4 equals $1.11 per share per year. If you own 200 shares, you get $222 per year, $55.50 every 3 months. That's it. That's the cash hitting your account. Dividend yield, your bang for your buck percentage. Yield tells you, if I buy the stock today, what percent return will I get just from dividends each year? Super easy formula. Yield percent equals annual dividend per share divided by current stock price times 100 AT&T example, March 2026. Annual dividend equals $1.11. Stock price today approximately equals $29. Yield equals $1.11 divided by $29 times 100 approximately equals 3.8%. So if you invest $1,000 in AT&T right now, you get about $38 in dividends over the next year. Nice and steady. Quick high yield example. PNNT pays about 96 cents per year and trades around $5. Yield approximately 19%. That means $1,000 invested could give approximately $190 per year in dividends. But remember, higher yield usually means higher risk. Payout ratio. Is this dividend safe and likely to continue? This shows how much of the company's profits they're giving away as dividends. Easy version, payout ratio percent equals annual dividend per share divided by earnings per share times 100 healthy range for most companies, 40 to 70%. Below 40%, very safe. 40 to 70%, sustainable. Over 80 to 90%, risky. A T&T example. Annual dividend equals $1.11. Earnings per share, recent, approximately $3.05. Payout ratio equals 1.11 divided by 3.05 times 100 is approximately 36%. That's excellent, very safe. Quick bonus tip for beginners. Always look at these 3 together. Good yield, healthy payout ratio, bonus. Does the company raise the dividend every year? That's even better. You can find all these numbers free on Yahoo Finance, Google Finance, or your broker's app. Search the ticker plus dividends. See, that wasn't scary at all. Now you can look at any dividend stock and quickly answer, how much will I get? And is it probably safe? Section 4, monthly versus quarterly dividends. Simple explanation and comparison. Now that you know what dividends are and why they're great, let's talk about when you get the money. Some stocks and funds pay you every 3 months, quarterly. Others pay every month, monthly. Here's the plain difference and which might fit you better in 2026. Quarterly dividends, every 3 months. Most big, safe companies pay this way. AT&T, Walmart, Coca-Cola, Procter & Gamble, and most dividend aristocrats. What it looks like, you get one bigger payment 4 times a year, usually right after the company reports earnings. Good things comes from very stable, trusted companies with long histories of never cutting dividends. Bigger checks, helpful if you want to pay a larger bill, save for a trip, or invest a lump sum. Fewer payments to track, simple and low maintenance. Money only shows up every 3 months, can feel slow or uneven if you need steady cash. If you reinvest, your new shares wait longer before earning more dividends. Monthly dividends. Every month, many REITs, BDCs, and income ETFs pay monthly. Realty Income, the monthly dividend company, EPR Properties, Main Street Capital, JEPQ, PNNT. What it looks like, smaller checks arrive 12 times a year. Feels like a regular paycheck. Good things, steady cash every single month. Great for bills, groceries, retirement spending, or just feeling consistent. If you reinvest, dividends, buy more shares, sooner leads to your money compounds a tiny bit faster over many years. Frequent wins keep you excited and motivated to stay invested. Downsides, each payment is smaller, doesn't feel as big as quarterly ones. Often from higher yield but sometimes higher risk investments like REITs or BDCs, more sensitive to interest rates or the economy. Best for steady income and budgeting. Monthly, Realty Income, JEPQ, PNNT, give that paycheck feeling every 30 days. Best for rock-solid stability and bigger chunks. Quarterly, AT&T, Walmart, proven through decades of ups and downs. Compounding edge, monthly wins slightly long-term because reinvestment happens more often. Risk level, quarterly, usually lower risk. Monthly can be higher yield. If you want calm, reliable payments and don't mind waiting a bit, go quarterly. If you want money coming in every month to match your expenses or feel more active, go monthly. Many smart investors do both. Quarterly for safety anchors, monthly for smooth cash flow. That's it. Monthly feels like a paycheck. Quarterly feels like a bonus. Pick what matches your life. Section 5. Top high dividend picks for March 2026. This is the fun part. My top high dividend picks for right now in March 2026. These blend safety, big yields, and smart income. Yields are current as of early March. Always check latest. Markets move. AT&T, reliable telecom giant, big U.S. provider of wireless, broadband, and fiber. Focused on 5G and home internet after dropping media businesses. Yield, approximately 3.8 to 3.9%, $1.11 annual, quarterly $0.27 and 75 cents. Payout ratio approximately 36 to 40%. Very safe with room to grow. Steady cash from millions of customers. Perfect for conservative folks wanting calm income. Risks, competition from T-Mobile/Verizon, some debt but shrinking. Walmart, WMT, recession-proof retail. King huge stores, groceries, e-commerce powerhouse. People shop here no matter what. Dividend aristocrat with 53 straight years of increases. Yield approximately 0.8 to 1%, 99 cents annual, quarterly 247 cents after recent raise. Lower yield but amazing growth track record and defensive business. Great long-term core holding. Risks, slim retail margins, but groceries buffer it. PNNT, Pennant Park Investment, ultra-high yield, BDC business development company lending to mid-sized companies secured loans. Must pay out 90% plus income. Yield approximately 18 to 19%, monthly $0.08 per share, base plus supplemental. Monster income with that paycheck feel, strong for aggressive income seekers. Risks, higher risk, economy slowdowns, hurt borrowers, possible payout changes. Monitor closely. JEPQ, JP Morgan, NASDAQ Equity, Premium Income, ETF, Active ETF, mixing NASDAQ 100 stocks plus partial covered calls for extra income. From trusted JP Morgan. Yield, approximately 10.7 to 11%. Monthly, approximately $0.51 per share recently. High income with more growth room than full call funds. Ideal for tech exposure, plus juicy payouts in 2026 volatility. Risks. Calls limit some upside. NASDAQ swings affect price. REIT, Spotlight, Realty Income, O, and EPR Properties. REITs must pay 90% plus income as dividends. Reliable high yields? No. Property management needed. Realty Income, O, monthly dividend company. Owns 15,000 plus retail spots. Walgreens, Dollar General, with long leases. Yield, approximately 5.0%, $3.24 annual, monthly 27 cents. 30 plus years of raises, 98% plus occupancy. Ultimate monthly passive real estate, EPR Properties, experiential focus, theaters, resorts, entertainment. Yield, approximately 6 to 7% monthly. Adds fund diversification. Risks, sensitive to rates, stabilizing now, and tenants. But these are strong. Mix these for balance. AT&T/Walmart for safety. PNNT for max yield. JEPQ for growth plus income. Realty Income for monthly magic. Diversify and start small. There you have it. Dividends demystified for 2026 success. Start small, diversify, and reinvest for massive growth. Which stock are you eyeing? Drop it in the comments, like if this helped, and subscribe for more investing tips. Hit that bell to never miss a video. Check the description for links to brokers and tools. Remember, investing involves risk. Consult a pro. Thanks for watching. Go build that passive income empire.